Hi, I'm Kep Kepner, CPA here in Dallas. It's near the end of the year. There's some tax advice that you need to hear. The first thing you have to do is know what your taxable income is likely to be, not only for this year, but for next. Let's say that next year you're going to do a major expansion of your business, and so your profits are going to fall. You're going to spend everything on growing your business, so you may not have any profits at all. So why would you want tax deductions next year? You wouldn't. You would want them this year when your income is high. Just the reverse may be true. This year you've invested in your business, the profits are low because you've spent a lot of money building your business, building the value of your business. So why do you want deductions this year? You would want them next year when you bear the fruit of your expansion. So tax planning is really about knowing 2 different years. And once you have a feel for that, you can decide when you're going to spend the money to get the various tax deductions. I'll give you a clue what some people do. They actually pay their property tax 2 years worth of property tax in 1 year, the 1st of January and before the end of December, and the next year they pay no property tax. The 3rd year they pay property tax in January and again in December. So what they've done, if that's somebody who has, let's say, $10,000 of property tax, in years 1 and 3, they have $20,000 of tax deductions. Now, how does that affect them? Well, property taxes are deducted on a Schedule A, where you have your personal itemized deductions. And so, personal itemized deductions are a great tax benefit if the sum of all those deductions are more than a standard number. Married filing jointly is around $12,000. So you might be better off pushing all of your deductions into 1 year and taking itemized deductions, and the next year not having the deductions and taking a standard deduction. People do the same thing with medical. You can't necessarily change your monthly medical premiums, but you certainly can decide when to spend money on medical procedures or buying medical equipment. So you can decide to do that in a year when you have high deductions, add them all together and get a much better tax benefit. Don't forget, when it comes to medical, you are going to have to eat the first part of your expenses. Generally, for somebody who's itemized for a long time, the first 7.5% of their adjusted gross income is a personal expense. So if you make $100,000 a year, the first $7,500 of medical expenses is on you. And the next dollar and all the rest of dollars may be deductible on your Schedule A. If you're a young person, then that number is 10%. So in that case, you make $100,000, the first $10,000 of medical expense is on you. You don't get any deduction for it. Then, every dollar after that, you get to add to your deductions on your Schedule A. Now, of course, that's unless you did some tax planning. If we're doing tax planning for you, we're going to see if you can't deduct some of that as self-employed health insurance. Okay. So we're going to see if you can deduct some of that as self-employed health insurance. So you get a dollar for dollar at the front end instead of seeing if it adds to your Schedule A. So you can stack your deductions or not use them in various years. I'm not liking that, so I'll go back to that part. You can stack your deductions in a particular year to get the highest tax advantage. But you need to plan. And you need to know that there are 2 tax years you're considering at all times. So if you need help with this complicated area, let us know. Thanks.